Welcome to Westchester Talk Radio, and we produced today by Shaw Creative and made possible by Entergy, Indian Point Energy Center. And we're here once again with our friends from Hightower Westchester, located in Harrison, New York, in Westchester County. I'm Bob Marone. We're here with Peter Lang, Managing Director and Partner at Hightower Westchester. On this podcast, we want to cover some year-end planning ideas that can be beneficial to many. Doubtful that all 10 or 12 things we want to cover will be applicable to everyone, but I think almost everyone can get at least one or two achievable ideas that can be beneficial. So here goes. Good day, Peter. How are you?
I'm great, Bob. How you doing? Thanks for having me back yet again.
Well, it's good to see you. Peter, let's talk about investments and capital gains. It's been a crazy year in the markets. So how are you dealing with it this year?
Well, this year, certainly, we've seen extremes on both the downside that we saw in February, March, and then we saw an extreme upswing in the market in, May, June, July, and still the rally is continuing, pretty far into the year. So because of that, and because of the unusual amount of volatility in the year, we guess, and we're already seeing it now as we're reviewing portfolios, a lot of either capital gains or losses. One of the general goals that we do every year that we go through with clients is trying to pair off the gains and losses. So it's very simple. Let's just say where we are in the year, we tally up all of the gains that we have, and let's assume we've got positive gains, realized gains, things that we've sold for the year and gave us a profit for the year. Now we go back and look at a portfolio and we look to see if there are losses in positions that we can take to pair off the gains and losses. By thus pairing them off, we ultimately reduce the client's tax liability when they do their taxes in April. So as like a real life example, let's say where we're sitting right now for a year, we have a client with $25,000 of realized, let's assume they're all long-term capital gains. And we go through the portfolio and we find $15,000 worth of losses that we think make sense to take. We will then take those losses, in other words, sell those stock or bond or mutual fund positions out, realize that loss. Therefore, we now have a net capital gain of $10,000, saving our client generally capital gains, or let's just assume for purposes of this discussion, capital gains are taxed at 20% on the federal level, plus a little bit for the state. So let's just assume 20% just to make the math easy for everybody here. By selling the $15,000 worth of losses, we've therefore saved the client about $6,000 in federal income taxes. Now, there's one little caveat to be aware of when we take that loss. There's always a little caveat when you're talking taxes.
I know.
There's something called the wash sale rule. Meaning when you sell stock ABC at a loss, and you realize that loss, you have to wait 31 days before you can buy ABC back into your portfolio. If you buy it, let's say 25 days later, that loss is disallowed. So therefore, what your best of intention is to realize the loss and use it to offset your taxes. You've now undone that by buying it back a few days early. So simply wait 31 days. So if you sell it today, add 31 days to it, calendar days, not working days, buy it back on the 31st day, because if you really still want to hold that position, you just have to wait that period of time to buy it back, therefore not negating the loss that you were attempting to do.
Peter, most savvy investors know that. How common is that mistake?
It's more common than you think, and it's just a matter of just being careful. That's all. It happens. It happens to great investors. It happens to new investors. It trips up the best of us and the worst of us. And it's just, again, be mindful of that one little fact. I know when we do it for clients, we automatically will put a little reminder on our calendar saying, okay, buy back XYZ for John Smith. And I'll know that means, okay, we waited the 31 days. It's safe to go ahead and buy it back.
Can we talk about IRAs and how those taxes work when you start withdrawals for those over 72 years of age. I read that this year was different. If
Yeah.
so, how so?
Yes, this year, well, we ended up with a confluence of events that occurred. So first off, had this been a normal non-pandemic year, starting this year for many clients, the required minimum distribution age went up from 70 and a half to 72. So for those clients who were not yet 70 and a half in prior years, they got an extra 18 months, let's just say a year to 2 years, to avoid or being able to continue to defer taking withdrawals from their IRA accounts. In the CARES Act that was passed in March, the government told everybody, wait, we're trying to, help everybody. You don't have to take any money out of your IRA this year. You can leave the money in your IRA. If you're over age 72, there is no more required minimum distribution. What they were trying to do was help people to keep more money, therefore lessen their tax bill for this year. So think of this year, let's assume that let's just pretend 75 years old. So you're already past either the 70 and a half or the 72, depending on where you fell. And you had a required minimum distribution this year. This year became, in essence, optional. You could take it if you wanted to. The government was saying you couldn't take it. They were simply saying you didn't have to take it. So in our case, we had the majority of our clients, we suggested that they not take their required distributions because they had other sources of money to take care of expenses. There were a few clients that still depended on their IRA distributions, and for those clients, we simply continued to take it for them. We weren't going to allow someone not to be able to turn their lights on because we were trying to save money in taxes. That doesn't make any sense.
Well, that was the question I was going to ask you. Do you have any sense of whether or not they will continue into the next year with that exception?
I highly doubt it. I mean, it was written into the CARES Act that it was for this year only. Now, we don't know if Congress will pass new laws or anything new. So there's always the possibility, but I wouldn't count on it. I would think it was a kind of a 1-year special exception that was made due to the most unusual year we've had.
We're talking with Peter Lang of Hightower Westchester here in Harrison, New York. Peter is managing director and partner at Hightower Westchester. Peter, what about using IRA money for charity? Are there any changes to that set of laws?
No, it's a great question. There's something called Qualified Charitable Distribution, QCD. And simply put, this allows anybody with an IRA who's in the stage of taking money out of their age 72 or older to take up to $100,000 per year and pay that directly to a charity of their choice. Therefore, that distribution also counts as their required minimum distribution. So let's say you as an individual have an IRA and your required minimum distribution in an ordinary year, forget this year for a second, was $90,000. You could take all $90,000 of that and donate it to your favorite charity or charities, and therefore you will have considered to be satisfied your required minimum distribution. So there are a couple of things to unpack that a little bit more. One is that $90,000 is not considered taxable income to you, so therefore you pay no taxes. On the flip side, you also get no tax credit for making a donation to your favorite charity. So it's kind of like that income and the deduction didn't exist in the year you did it. For most people, when we look at this, it's still very powerful to do so. Even though you're forgoing a tax deduction, you're also forgoing the income. Now, this year, again, there's no required minimum distribution required, but you could still give up to $100,000 to your favorite charity. Again, there's no deduction, there's no income, so there's no tax impact to you, but you can still go ahead and do it this year.
Peter, are there any other charitable ideas for those who are so inclined?
Aside from obviously just simply writing the check to your favorite charity, one of the things that we've seen tremendous growth in, and not in many different ones that are out there, are donor advised funds, known as DAFs for short. Think of a donor advised fund as itself a charity. So I'll give you a real life example. My wife and I and my children, we have a donor advised fund. We periodically donate appreciated stock to the donor advised fund. When we make that donation of appreciated stock, that completes the gift to the charity. So therefore, if I bought a stock, let's say 5 years ago for $5,000, and it's now worth $10,000, instead of selling the stock and then giving the money to charity, I donate the $10,000 worth of stock to the donor advised fund that I maintain. That completes the donation. So I receive a tax deduction for a $10,000 gift. Now, subsequent to that gift, at some point, a day later, a week later, 5 years later, I can then choose to take that $10,000 and then recommend to the donor advised fund that they then send $10,000 to the Salvation Army, to the United Way, to whomever we've selected to receive those funds.
Now, when do you take the write-off?
You take the write-off in the year that you make the gift to the donor advised fund.
I see.
So again, in my example, I make the donation today of $10,000. I get a tax deduction of $10,000 for the 2020 tax year. And let's pretend I do nothing with that $10,000 sits in the donor advised fund. And in 2 years from now, in the year 2022, we decide we want to give that money to, again, XYZ favorite charity. There's no further deduction for anybody at that time. And in 2 years from now, that charity gets the money.
Is that you maintain control over that money, even though it's at the donor advised fund?
I maintain limited control. The only control that I have over that money is within the donor advised fund, kind of like a 401k plan. There are limited investment choices to make. So I can designate my $10,000 gift to be invested either conservatively, moderately, aggressively in certain pre-made buckets. In my case, we use the Fidelity Donor Advised Fund, but Vanguard has one, and there are lots of other ones. So we can choose to have the money as invested, but it's pre-selected, kind of like a 401k plan, right? In a 401k plan, you get a fund menu of whatever, let's say 5 or 10 different mutual fund choices. It's kind of the same thing. So that's the only control I have. And then again, my last bit of control is requesting a grant being made from the donor advised fund to the end charity that we've selected.
Very, very interesting, Peter Lang. Are there any other unique or one-time things that people can do this year to access their retirement accounts if they need the funds? Let's say because of the pandemic, some people need cash in their pockets.
Absolutely. One of the other things within the CARES Act was something called a qualified withdrawal. In other words, allowing somebody that needs the money, right? Needs the money to pay rent, to pay the mortgage, to pay whatever the bill is. They've lost their job, they've lost their income. And even if they're getting unemployment, whether they are or they're not, but they just don't have enough money to take care of what they need, they are allowed to withdraw up to $100,000 from either their 401k plan or their IRA. If they're under 59 and a half, normally there's a 10% tax penalty for taking money out early. That 10% penalty is waived. And the taxes that would ordinarily be owed on that withdrawal are spread out over 3 years. So instead of having to pay that, whatever tax bracket you're in immediately this year, or when you do your taxes in April, you have 3 years to spread it out. Now, theoretically, you have to show that you have to be able to demonstrate a demonstrated need as determined by the law. The issue, of course, is we don't really know what fulfills a demonstrated need. but that's kind of one of the caveats to it. Look, we would never recommend a client do this to kind of quote unquote game the tax system or have a tax arbitrage, right? Being able to spread the taxes over 3 years, it just isn't worth it. It's not really worth borrowing from your future unless you absolutely have to have the money.
You know, I've read a lot about converting an IRA to a Roth. Can you please explain how that works and how it might be beneficial this year?
Sure.
Yeah, an IRA to a Roth.
Yes. Okay. So if you have a traditional IRA account, let's say you've opened up this account years and years ago and you've contributed, and let's just say that in that traditional IRA account, you have $100,000 in that IRA account. And let's just say, for argument's sake, you're 55 years old, okay? And you're still working, and you're not going to be touching that money for another 10, 15 years, and your required withdrawals don't start for, say, another 17 years. You may make a decision, you know what? I'm going to take that $100,000 and roll it over into a Roth IRA. So you're converting the $100,000 today from the traditional to a Roth IRA. Now that will trigger taxes this tax year, right? And you will pay whatever bracket you're in. Let's just pretend you're in the 30% tax bracket. So $100,000, 30%, $30,000, you're going to owe $30,000 worth of taxes. Now, to make it work, whenever we run these for clients, you always kind of have to have the money in an account other than the IRA account, right? So now you've got $30,000 sitting in the savings account somewhere. That's the money that you used to pay taxes. So now what's the advantage? Well, you've just, again, paid $30,000 worth of taxes. In the Roth, that IRA, that $100,000 is still tax sheltered, right? There is still no tax on any of the investment gains, dividends, capital gains. Anything that goes on is completely tax sheltered. Fast forward 17, 18 years from now when you're 72, and let's say that $100,000 has tripled in size. It's now worth $300,000, right? At 72, you would have to start taking required minimum distributions in a traditional IRA. In a Roth IRA, there are no required minimum distributions. Any withdrawal you take out of a Roth IRA is 100% voluntary. So now let's say, so do apples to apples comparison. Again, let's fast forward, you're 72, the 100,000 in either case is triple to $300,000. Let's just make up some numbers here. Let's say your required minimum distribution in that year is $50,000, and it wouldn't be that high, but I'm just making up numbers to make the math easy for us. Let's assume you're still in that same 30% tax bracket. That's going to cost you $15,000 when you're 72. Now, instead, in the Roth, I've already paid $30,000, and now in 17, 18 years from now, I decide to take out that same $50,000. I pay nothing in taxes.
You know, this is really interesting, this conversion. It reminds me, you know, in some of the other markets where the government is saying, give me some money now, and then, you know, you've got a free ride later on. But of course, there are no guarantees in any of these transactions, but it is very clear how that works. Well done.
Yeah, and one of the reasons people also do this is they feel perhaps they're going to be in a lower tax bracket this year than next year. You know, we never know if taxes will be increased or decreased. Realistically, we think we're in one of the lower tax environments that we're going to be in. So a couple years out, we could be facing higher taxes. So doing it today also makes some sense, potentially because you're in a lower tax bracket today than you might be in 5 years from now.
I could go on and on about that one alone. In the interest of time, we'll move on to something I find really interesting. I read something about something called an NUA. What is that?
Thanks, Bob. So NUA is a kind of unique little strategy relative to rolling over a 401k account for a client. So let's say, and it stands for, NUA stands for net unrealized appreciation. It's something you can only choose to do at the time of rolling over. Let's say you've retired, and let's say you worked at ABC big company, and you worked there for 30 years. And in your 401k account, there ended up being a lot of company stock that was given to you over the years as company matches or purchases that you made voluntarily in the 401k plan. And let's just, again, let's make up some nice round numbers for ease sake. Let's say in your 401k account from ABC Big Company, there's $2 million, and 500,000 of that is in company stock. And let's also assume that the company stock is highly appreciated. Let's assume for this discussion that the company stock has a cost basis of $100,000, but is worth $500,000. So now you've retired and you say, okay, I want to roll my money out of the plan. Well, option one is you can roll 100% of it, all $2 million from the 401k to your IRA account, and you pay zero taxes, nothing. And then the IRA gets invested, and when you turn 72, you'll take out withdrawals, period. Now let's say you instead say, I want to take that NUA, that 500,000, and I want to take that out separately. So now what you're doing is you're splitting that $2 million 401k account. So the $1.5 million still gets rolled into the IRA, no taxes owed, continues to grow. The other 500,000 now rolls into your personal account, your individual investment account. You will pay tax on the cost basis as ordinary income. So remember, I said the cost basis was $100,000. So now the $100,000 is treated as ordinary income. Again, argument's sake, we'll assume 30% tax bracket, $30,000 worth of taxes owed. Now remember, you rolled out $500,000. You only paid tax on 100 because that's the cost basis.
Now, if I'm hearing you right, and I believe that I am, I do not have to pay money on the gain. I don't have to pay tax on these capital gains.
Not yet. Now again, it's now a long-term.
Not at the time of rollover. Okay. Go ahead.
So that 500,000 is sitting in your individual, not your tax sheltered account.
Right.
So you paid $30,000 today, and now let's say in a year, 2 years from now, you decide you want to sell, for argument's sake, all of that company stock. And let's just, again, argument's sake, let's say it hasn't grown at all since then. So it's now worth still $500,000. You have a $400,000 capital gain. Capital gain rates are usually at a more tax-favored rate. So for instance, right now, capital gains are at 20%, a base capital gains rate, not including the 3.8 surtax and state tax. Let's just pretend they're 20% for argument's sake. So on that $400,000 capital gain, you would pay capital gains tax. So you sell the $500,000 worth of stock in a couple of years because you want to buy your dream home somewhere else, and you're going to use that stock money for it. Well, you're going to pay 20% of the $400,000, or about $80,000 plus whatever applicable state, and if there's a surcharge is still around, there'll be that as well. So for taking $500,000 out of your IRA account, ordinarily all $500,000, if you took it in your individual account, would be taxed at 30%, or about $150,000 in total taxes. Instead, you've paid about $110,000 of taxes, maybe 120 if we add a little bit more in for a little bit of state tax. So the difference is $30,000 that you've kept and will kind of keep forever. So again, it's a very powerful strategy. The two caveats are it only works on company stock. So it can't be stock that you bought within the 401k of some other stock. It has to be the company stock that you worked for. And it has to be elected at the time of rollover. So you can't say, oh, well, I rolled it over 6 months ago. Can I go back and redo it? No. You have to do it at the time you roll the money over.
And the other caveat?
Those are the two caveats. It has to be done at the time of rollover.
What if the market should go down, and by the time I sell these shares, they're worth $300,000?
Well, then your capital gain is now only $200,000, and you'll pay a capital gain on $200,000. The other way to look at it is you may say, okay, for the next few years, I'm going to simply sell $50,000 worth of stock every year, because I'm going to live on that
Mhm.
money. So now you've got a capital gain of, let's say, every time you sell there's a, a $40,000 or $45,000 capital gain. At 20%, you're paying, $8,000 or $10,000 worth of taxes on an annual basis, and you're keeping the rest.
That's pretty good.
Yep.
All right. What are the limits? These change every year. And of course, we're talking about IRAs. What are the limits in terms of contributions for IRA and other retirement accounts this year?
Sure. So this year in 2020, if you're under 50, it's a $6,000 IRA limit on an IRA contribution. If you're over 50, you get to put an extra $1,000 as your catch up, so a total of $7,000. In a 401k this year, there is a maximum contribution if you're under 50 of $19,500, and if you're over 50, you can put an extra $6,500 for a total of $26,000. So as we always suggest to our clients, if you have a job and you're working at a 401, you have a 401k plan, always max that out first before you consider an IRA contribution, because the limit is basically almost 4 times higher in a 401k than an IRA.
Absolutely. And then to underscore it, we're talking $26,000 versus $7,000.
Correct.
How about gifts and saving for college?
Great. Well, every year, every person can gift up to $15,000 to any other person they wish. Child can gift to parents, grandparents can gift to their children and grandchildren, nieces, nephews, etc. So that $15,000 annual exclusion is unlimited to the number of people you can gift to. And so that's both tax-free for the recipient and the giver of the gift. The other thing that you can also do is also save for 529. So that same $15,000 gift also would apply to savings you're making on behalf of your child or grandchild in their 529 accounts. The one little special caveat in a 529 is you can actually make 5 years worth of gifts today into a child's 529 account. So again, what you've done is, in this case, it's 15,000 times 5 is 75,000. So today, you could make a $75,000 gift to your child, grandchild into their 529, but you've now used up the next 5 years worth of gifts to them. The advantage of doing it in a one-time shot is in a 529, you've got 5 more years of this tax-deferred growth for their benefit.
That's terrific, being able to do that.
Mm-hmm.
Okay, before we wrap it up, and I want to remind people, we've been talking with Peter Lang. He's the managing director and a partner at Hightower Westchester here in Harrison. And we've been talking, of course, about year-end planning. Any last tips before we wrap it up, Peter?
The only last tip I would make is, make sure you consult with your tax advisor about any of these strategies that we've spoken about. And when you speak to your tax advisor about these strategies that we're speaking about, don't forget to make your last and final fourth quarter estimated tax payment that is due on January 15th. Obviously this year, initial taxes were pushed off to July 15th. Extended taxes were October 15th. I would suggest to everybody that we should plan for your 2020 taxes to be due April 15th. So your Q4 still needs to be paid on January 15th. And you're doing that to help avoid interest and penalty if you under withheld taxes during the year.
Wow, Peter, I can't thank you enough. Once again, you make this information so clear for us. Thank you.
Always a pleasure.
Thank you, Hightower Westchester here in Harrison. Their video cast, we're Westchester Talk Radio, provided by Shaw Creative and made possible by Entergy, Indian Point Energy Center. I'm Bob Marone for Westchester Talk Radio. Thank you for listening. And thank you again, Peter.
You're welcome. Thanks, Bob.
Hightower Westchester is a group of investment professionals registered with Hightower Securities LLC, member FINRA and SIPC, and with Hightower Advisors LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities LLC. Advisory services are offered through Hightower Advisors LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein herein are from sources believed to be reliable. Any opinions, news, research, analyses, prices, or other information contained in this research is provided as a general market commentary. It does not constitute investment advice. Hightower Westchester and Hightower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This podcast was created for informational purposes only. The opinions expressed are solely those of Hightower Westchester and do not represent those of Hightower Advisors LLC or any of its affiliates. Hightower Advisors do not provide tax or legal advice. This material was not intended or written to be used or presented to any entity as tax advice or tax information. Tax laws vary based on the client's individual circumstances and can change at any time without notice. Clients are urged to consult their tax or legal advisor before establishing a retirement plan.